Welcome to GRE. I'm your host, Keith Weinhold. Real estate has a lucrative and largely undiscovered space within it. Even if you've been attracted to this niche, it can be hard for an individual investor to get started until you learn about a solution today. What is this niche and what makes it profitable? There's a great education here today on Get Rich Education. For accredited investors, if you've ever dreamed about making 10 to 12% of passive income annually, Wagner and Alasko and his partners of professional syndicators have the answer for you. Invest in one of the safest assets available on the planet, real estate. On a preferred return basis, you will collect your money before anyone else does. To find out more about these opportunities, visit I'mAccredited.com or text 305-684-2222 for your free investment guide. You know, a lot of investors choose either cash flow or home price appreciation, but one real estate market could provide both: Jacksonville, Florida. They've got 27% lower home prices and higher rents than the national median. Their market has appreciated 34% more than other comparable cash flow markets over the last 30 years. Get positive cash flow today and above average appreciation for tomorrow. They often have available inventory in Jacksonville, if you can believe that. Start at cashflowandgrowth.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Hey, welcome to GRE. From Pretoria, South Africa to Victoria, BC, and across 188 nations worldwide, I'm Keith Weinhold. This is Get Rich Education, building your wealth with real assets in inflationary times. Before we discuss this largely undiscovered real estate niche today, I've had a few questions about last week's show and people interested in our investment counselor program. Yes, free coaching, which is especially germane to you if you haven't owned investment property before, or if you're just otherwise unfamiliar with the process. You're like, what? Actual available properties during this astounding era of this paucity of inventory and one-on-one help for you? Yes, in order to do that directly and get a hold of Naresh, you can email him at naresh@getricheducation.com. That's Naresh at getricheducation.com. On today's show, you know, real estate has one largely, I'll call it undiscovered space, with the word space actually being the constructive one here. And people that are in it are passionate about it and they just want more of it. And that is the self-storage space, self-storage facilities. And really, this is a paradox in a few different ways. It's quite apparent now that the way that humans interact with residential real estate, their own home, that has changed in a number of ways in the past few generations. When we look at storing stuff, I think first we think about the closet. Well, there were no walk-in closets 100 years ago, and now there are. And garages are bigger now. People have more stuff. Over the last 50 years, the number of people living in a U.S. household has shrunk because people are having fewer kids, for one thing. But yet at the same time, houses have gotten larger, even though there are fewer people in them. There are over 50,000 self-storage facilities nationwide, and that is about as many as McDonald's and Subway and Starbucks combined. Now, 3/4 of these are owned by independent operators, and out of those, 2 of 3 are mom and pop operators, these small individual investors. So this undiscovered niche of self-storage is really a fragmented industry. And when something is fragmented, there's often an opportunity to bring in efficiencies. And yeah, those that own self-storage facilities, they swear by them, and they say it is the absolute best niche in real estate investing. But see, a lot of these mom and pop operators, they lack the resources and knowledge or even the desire to increase the income and maximize the value of these facilities. So therefore, a professional operator can come in and pay a fair price and increase the income and the value. And that's how investors can go ahead and come alongside of them and profit from this. And there is a substantial difference between a mediocre operation and a self-storage facility that operates professionally. There's a big delta there. Now, typically, self-storage tenants have month-to-month agreements. And what these month-to-month agreements do, rather than these annual agreements, is oftentimes this attracts these self-storage tenants in the first place because they do end up staying longer than they think and add more and more months and more years to what appeared to be, in their mind, a short-term contract at the beginning. And the other thing that month-to-month leases do is they help you capture inflation more easily. You're more nimble that way rather than having, say, a 10-year commercial lease that has some modest escalators in it. Our expert guest today is going to be a familiar voice to you because he also offers ATM investments. So we'll get a quick update there before learning about real estate's largely undiscovered niche of self-storage facilities. Today's guest is a real estate syndicator extraordinaire. He's an investment and tax strategist, and his team is one of the top 5 ATM operators in the nation. We've had him here before to discuss ATMs. And like me, he is also a fellow distance runner and fellow native Pennsylvanian. Welcome back to GRE, Dave Zook.
Keith, thanks for having me back. I'm looking forward to it.
Hey, before we talk about the opportunity in the self-storage space today, can you give us an update on what's happening in the ATM space?
Couple new developments. One, we've had an incredible amount of demand in the space. In fact, so much so that we haven't gone live with portfolio for the last, since September of 21. So it's been about 6 months. So we're just now rolling out a portfolio. So there's a couple new things, a couple new twists to this one. One especially. So for the first time ever on GRE, you may hear about leverage on ATMs. Now, historically, you think about leverage against real estate. And very seldom will a lender lend against an asset like an ATM for obvious reasons, depreciation, all that good stuff. But we now have a leverage option. So obviously, you must qualify if you're a high net worth investor, and you can invest in 5 units of ATMs, which is $520,000. But they will come alongside and they'll do a 50% leverage option on the front end. And it quickly goes to about a 72 to 74% LTV. This is a bigger conversation, but the main thing is I just wanted to let you know that it is available. What is an ATM investment for your listeners that haven't heard about this before? It's a strong cash flow investment. It's a strong tax play. So $2,142 per month for 7 years. You get 100% bonus depreciation.
That's your cash flow that you just stated there.
Yep, $2,142 per month in cash flow, so about a 24.5% cash-on-cash return with about a 19% IRR. Here's where the magic happens, though. When you apply leverage to something that has 100% bonus depreciation, even if it's just 50% leverage, you know what that does to your 100% bonus depreciation? It makes it 200% bonus depreciation in year one. So just wanted to let you know, this is something that I haven't talked about on any podcast or radio show before. So GRE is first up, and your listeners get a chance at this fund. Again, you got to qualify. We'll connect you with our lender, but we can make this happen for you.
Well, thank you for making the announcement here. ATMs, an investor buying a lot of 5 of them. It's probably the best cash flowing investment I've ever heard of. Dave spoke to the tax benefits, and now we have leverage coming alongside that as well. If you're new to that, if that's something that you want to learn more about, you can do that at gremarketplace.com/ATM, as Dave does have the team that's one of the top 5 ATM operators in the nation. Now, you're really an expert beyond being an experienced syndicator with identifying opportunities and putting together teams and operators for those opportunities, like you've done so well in the ATM space. And one place that you've done that is in the self-storage space. So what first got you interested in the self-storage space?
It was we were going into 2017 and 18, and we had acquired several thousand multifamily apartment assets, several thousand units. And I just felt like we were due for cool down, a pullback of some sort. And so I knew from studying the self-storage asset class that it was an asset class that it was one of the best asset classes in real estate as far as performance throughout some kind of disruption, some kind of pullback, some kind of maybe recession. When you look back at 2008, that's how you can time test some of your investments or asset classes. Okay, how did this thing do throughout 2008, 9, and 10? What did that look like? Well, when you look back there, self-storage was the strongest performing asset class coming out of that. Number one, it was least affected to the downside, and it was strongest performing coming out of that period. And so I was attracted to it for that reason, amongst others. Look, I was busy. I never really had a good entry point. I mean, yeah, you can go out and invest some of your money with a group, but not something to where I felt comfortable with that we could scale. I eventually ran into this group. As you know, this investment community is fairly small. And if you keep hearing good things about a specific group, it kind of grabs my attention. So eventually I kept hearing about this group, and finally I said, look, I got to meet these guys. And we ended up doing a deal. I don't know if you were aware of this, Keith, but in November, we sold 26 properties to a REIT out of Chicago, and it was a $450 million deal. And we returned just over 30% annualized to our investors who had invested with us for the last couple of years. And that was a lot of fun. But this is a really strong group. I got to know them through mutual friends and investors, and we ended up doing a lot of business with them.
That's remarkable. Speaking to the recession resistance part of being in the self-storage space, I mean, a person can make hunches or guesses or hypotheses, but I think a smart way to approach what might be recession resistant is to look at history like you did. What happened from 2008 to 2010 when it seemed like the investment world and the entire world was falling apart? If we think about really the use case at its core for self-storage units, it's pretty interesting. And I really think it's an exercise in American culture. 25 years ago, there was no iPhone yet. And the iPhone has dematerialized so many things over the last 25 years. So wouldn't people have less stuff and hence less desire for storing items? We're talking about how the iPhone replaced the radio, the newspaper, a landline phone, a big TV, an alarm clock, a camcorder, paper books, paper calendars, and all those sorts of things. I think America is just replete with consumerism. It's cultural. People want their stuff, and people are sentimental as well, and they store stuff even when it doesn't make sense to that tenant's personal economy.
Americans like our stuff. And, it's amazing when, in the rare occasions when you got to sift through some of that stuff. Let's say a tenant doesn't pay his rent for several weeks. You can go through there, and it's amazing what you find in some of those storage units that have been paying the storage fees for 2, 3, 4 years.
Right.
The value of the stuff isn't worth the amount of money that they pay to store. So it's amazing. But, most people go into a self-storage facility thinking that it's going to be a 3, 4, 5 month deal, thinking, oh, yeah, I got to do a short term. I got to store my junk for a couple months, then I'll move it out of here. And it ends up being 2, 3, 4, 5 years. Because the pain of the relatively small cost of renting that 10 by 10 storage space isn't worth the pain of getting a truck, renting a trailer, moving your crap somewhere across the other side of town. And so people just auto pay it. And it just 2, 3, 4 months ends up becoming 2, 3, 4 years.
To speak more to the recession resistance part two, oftentimes tenants are compelled or forced to store things due to what they call the 4 Ds: downsizing, divorce, dislocation, and death. Why don't we talk about what exactly are tenants storing there? I think a lot of people think of the contents of a self-storage unit as being a bunch of cardboard boxes, and it surely could be. But I think we know that oftentimes anymore, people really pay a premium for storing an RV or a boat or a car. So what are people keeping there these days, Dave?
Most of the stuff that is stored inside, and we've got a lot of climate controlled. We do a lot of business in the Southeast. In fact, probably 97% of our portfolio is in the Southeast. And so we've got a lot of climate controlled units. Most of the stuff that we see that gets stored in, it has some kind of sentimental value. It could be art. It could be boxes of stuff. It could be old baseball cards that they had when they were kids. Some of the stuff you look at, they haven't used it for 10 years. They won't use it for the next 10 years. But then, of course, like you mentioned, outside storage is also a thing. RVs, boats, cars. And depending on where those locations are, depends on the premium the price that it costs to store those things. I remember walking through our facility, and this was a Class A facility down in Key West, Florida. And many people think about a 10 by 10 storage space as costing somewhere around, $80 to $125 per month. And that's oftentimes the case. But in this scenario, Key West is a very high demand. It was very high barrier to entry to get into the market. And we were renting a 10 by 10 indoor 10 by 10 space for $425. We were renting an outdoor space to park a car. It was around $400 a month. There's all kinds of different products that people pay to store at a self-storage facility, whether it's inside or outside.
You got to love the tenant that moves in with a whole bunch of cardboard boxes full of 1982 Topps baseball cards. If they've held on to them for 40 years, they're not going to throw them away anytime soon. There's probably a good chance that they're a long-term tenant. And you talk about then, I think, what we could call a sticky tenant. They tend to stick around. And because the amount of rent that's charged is rather low for this, call it a 10-foot by 10-foot space in some cases, it might only be $100 rent. If you increase the rent to $110, they're probably not going to move out for $10 a month, but you go ahead and extrapolate that across all your self-storage units, and you just got a 10% rent increase yourself.
Not only have you increased your cash flow, but as you're very aware of, Keith, you've increased the value of your property by a good margin. So yes, that is true. And that is one of the things that you can get away with in a self-storage facility where you may not have that much flexibility in a multifamily housing project.
When we talk about the actual locations of these physical spaces, oftentimes they're not going to be in a premium area because for a tenant, in a way, it doesn't really make sense to store their stuff in a premium area. A tenant of one of these units, they might want to live on a lakefront, but it really wouldn't make sense to pay a premium for lakefront space for storage. And that does open up somewhat of a market there because a person doesn't want to store too much of their stuff, perhaps in a fancy home. So talk to us more about what really makes the best location for these places, Dave.
You're right on that, but you also need to have your self-storage facility in a place where people are already going. You want to make it so that, you don't have a storage shed in your backyard. You don't want to greatly inconvenience yourself every time you want to go and pick up something out of your storage facility. So you want to have your self-storage facility somewhere where people are already going to. Somewhere where there's good traffic. Typically, a good location is when you have a 15 to 25,000 car traffic count going past your place. And it is true. Like, what's the three most important things in real estate? It's location, location, location. Very much so in the self-storage space. You want to make it easy for people to find you. And you want to have a good road frontage where a lot of people are going past and where they don't have to drive 2, 3, 5 miles out of the way to go see their stuff.
Maybe good proximity to an expressway interchange or something like that. Not a premium area, but an easily accessible area for these. And I think when we picture a self-storage unit in our mind's eye, Dave, you mentioned the 10-foot by 10-foot dimension. I mean, is it really that much more than 4 pieces of sheet metal, a floor, and a door? I mean, these things are really pretty simple.
You're right. I mean, the cost per square foot to build versus the cost per square foot to rent, those numbers can be pretty compelling. And it's like you mentioned earlier, when you go up 10% on your rent, that's $10. Oftentimes, that could be $10 in a $100 monthly charge. People aren't going to move out for $10. When you would consider going up 10% in your apartment complex, that could make the difference. Oftentimes, if you're dealing with B and C class tenants, that could oftentimes make the difference. So you get away with some rent increases and some margin that you would not get away in most other asset classes.
And part of that margin comes from the low maintenance costs for the owners. No one actually lives there. There are no tenants on site, so there aren't any leaky faucets and there isn't any trash, for example. Why don't you talk to us about some of those other infrastructure and amenities that need to be there? How often are these climate controlled, for example, and what's security like?
In general, it's just a lot easier because you're dealing with a lot less people. I don't know how you've found it, Keith, and I love people. But most problems come with hair on top. The more people you're dealing with and the more moving parts you're dealing with, the more problems you're going to have. You're thinking about faucets and sinks and toilets and refrigerators and all kinds of moving parts in a housing project or a multifamily apartment that you don't have in a self-storage facility. So in general, when it's done right, from what I've found, the margins are much better and the problems are much fewer. Oftentimes, that's not the case. I even tell my kids, you get paid based on the amount or the size of the problems you get to figure out, right?
Sure.
Well, this is one of the rare asset classes where you have less problems, and if done right, you can have more margin than most other asset classes. We've got cameras, we've got security, we have personnel on site. Many of our locations, we've got an apartment above the store. The manager or one of the employees is living on site. It's not one of the sort of touchless self-storage facilities. We have somebody there. We have somebody manning the front. We have somebody living on site. And then, of course, we've got cameras and security systems and all. But the assets we're dealing with here are Class A. They're institutional products. Now, I'm sure, depending on where you go in the city and what kind of asset class you're dealing with, those things that you just mentioned, security, alarm system, all that stuff, becomes a whole lot more important. But we're dealing with institutional grade Class A assets here. So other than your typical security systems, cameras, having somebody on site, that's about it.
Now, you mentioned an on-site manager, so we're probably talking about properties with a few hundred units once we're there. Can you talk about some of the typical sizes of the self-storage properties in the space that you operate in there, Dave?
Many of our facilities are 50,000 square feet plus. So we could be getting into 50 to 125,000 square feet. Where we really shine is we take a facility. Oftentimes we're taking a 50, 60,000 square foot facility and we're adding another 15 to 30,000 square feet, oftentimes climate controlled, think southeast. And we're adding the square footage to that facility. And a couple of things we're doing there. Number one is we're taking care of the demand in the market. Number one, when you find this property, you want to make sure that the demand exceeds supply. So you've got a really good reason to increase the square footage. Now we're destabilizing that property. We're doing some construction or development. We turn around and restabilizing the property and then selling it to a REIT. So that's really our whole business model right there. And that in that short sentence, I just told you our whole business model. Our whole business model is we are sort of the middleman between a mom and pop operator and an institutional buyer. We buy properties from a mom and pop operator. Oftentimes that mom and pop operator only owns one property. We're buying that property. We're adding size and scale to it. We're adding square footage. We're forcing value through development or on bringing in ancillary items, U-Hauls, our professional management team. And then we're getting it to the point where we're stabilizing it and getting it ready to exit to an institution. We've done that with the last probably 35 to 40 properties that we've bought, held for 3 to 4 years, and then exited to a REIT at some crazy low cap rate.
That is quite a business model. We're talking about self-storage investing, where the tenant-landlord law often works more in your favor because there are fewer moving parts. If things went south, there isn't a tenant to evict. It can be easier to evict a non-paying tenant from those premises there. And you know what? You've got their stuff. You've got their stuff there too. We're going to talk more about the adding value component to self-storage facilities. How exactly do you do that? More coming back with Dave Zook after the break. This is Get Rich Education. I'm your host, Keith Weinhold. Hey, my friend Damian Lupo informed me that checkbook IRAs have been made illegal by the U.S. tax court. If you have a checkbook IRA, your holdings are now disqualified with taxes and penalties up to 50%. But don't panic, Damien and the EQRP company can fix this. Those IRAs can be converted into EQRPs retroactive to last year, getting those tax deductions and reducing your taxable income. And this way you can invest your 401k or IRA in real estate, Bitcoin, gold, and even your own business. So whether you're a full-time investor or retired or even a dentist with dozens of employees, if you're listening, you qualify, the EQRP works. It's the solution. You'll control your money, kill UBIT, and pay way less taxes. To learn more about this strategy and free up your retirement money, get the newest EQRP special report. Text GRE to 307-213-3475. That's text GRE to 307-213-3475. The people that our listeners can't stop talking about are Ridge Lending Group, NMLS 42056. They've provided GRE listeners with more loans than anyone, and it's where I got my last few loans. They finance single-family income property up to 4plexes. They're the number one lender for beginners and veterans. Start your pre-qualification, chat with President Shaley Ridge personally, and get your custom plan for expanding your cash-flowing portfolio. Start at ridgelendinggroup.com.
This is Rich Dad, Poor Dad, author Robert Kiyosaki. Listen to Get Rich Education with Keith Weinhold. Don't quit your daydream.
Welcome back to Get Rich Education. We're talking with Dave Zook about self-storage investing, a lucrative niche where people that are in the space are really passionate about the space, such that self-storage investing is just about all that they want to do. Dave, if I go and Google self-storage investing myself, one of the first things I find is REIT advertisements there, real estate investment trusts. You talk about how your opportunity is you will go buy an underperforming asset from a mom and pop investor, add the value, and then your exit strategy is selling it to a REIT, a real estate investment trust. So can you talk more about how you add the value? Part of that might have to do with occupancy rates, and part of it might be the physical premises or whatever else. How exactly do you add the value to these facilities?
Just lay some groundwork to that. There is an incredible amount of institutional demand in the self-storage space right now. These properties that we're buying and getting ready, doing the prep work and preparing to sell to a REIT, these are properties that we would love to hold for a long time. It's just the cap rates that they're throwing at us to acquire these properties, buy these properties from us, we can't afford to keep them. And so these are highly desirable properties. When we're done with them, we'd love to sit on for a long time. But as far as adding value to the property, oftentimes it's through some sort of development. I'll give you a quick example. We bought a 75,000 square foot facility right outside of Gainesville, Florida. We added two 25,000 square foot buildings to that property, making it 125,000 square feet. From the time we purchased the property to about 3 years and 8 months later, we sold that for a 3+X. I think it was 3.1X. We tripled the investors' money. But basically, we took that property. There was short supply, high demand. There was all kinds of new housing developments going on around it. We almost doubled the size, not quite. We almost doubled the size of that facility. We added another 50,000 square feet. We stabilized it. The NOI growth on that property was like 500 and something %. We got that property to the point where it was a highly desirable property for a REIT, and we know exactly what they're looking for. We've done this a lot of times now. We have the relationships. We have the relationships with the sellers. We have the relationships with the REITs. But I've been doing this a long time. We know what they're looking for, but we add value primarily through adding square footage. Then we bring in we're replacing the mom and pop team. Remember, they own this property. They own one property. They probably owned it for 10, 15 years. We're taking out maybe a little bit of a tired management team. We're bringing in our professional management team. We're raising those rents aggressively. Everything that we're doing is the question starts with how do we raise that NOI? How do we get that NOI up? And then we take it to market. We're bringing in U-Haul trucks many times. We're adding ancillary items to our store. We're boosting that side of the revenue and just really bringing in fresh legs, marketing, all that stuff that we're very good at, getting that NOI up and getting ready to sell to our REIT.
It's a very fractured industry, self-storage. A lot of times mom and pop operators, they might have owned it for 15 years, but they might lack some of the savvy and sophistication to turn that self-storage facility into its best and highest use. So you come in, buy it from that mom and pop operator so they get to be cashed out, add the value, and sell it to a REIT. So this really allows you're going to be more nimble than a REIT, because REITs typically aren't in business to go in and add the value themselves.
Yeah, and they have no appetite for that. Like, they have no interest in going and buying from that mom and pop, doing that development, doing everything that it takes. They want to buy a stabilized asset, and they'll pay a premium for the stabilized asset. It's really preparing that asset and delivering it to them. It wasn't a REIT target before. It wasn't on their radar before, but we're basically taking that mom and pop asset and we're delivering it to a REIT on a silver platter, saying, here it is fully stabilized. You can track it. You can look back at the last 12 months. You can see the NOI growth. It is here. It's stabilized. It's now ready for you.
Well, this is a really attractive asset class to some people, to some individual investors that just want to be passive and hands-off. But it's almost impossible for an individual investor to approach a self-storage unit of hundreds of thousands of square feet and own that all themselves. So you've made it really easy for individual investors to participate alongside you and benefit from your economies of scale. We know that the space can be lucrative. Earlier, you mentioned an equity multiple of 3.1. That basically means for every 100K in, an investor would get 310K out, for example. So tell us more about that investor participation for people that want to be in this without having to own it themselves.
Yeah, so we put a fund together specifically for the passive investor. And a passive investor, number one, they must be accredited, but they can invest in as little as $50,000 into the fund. And from that point, you hear from us quarterly. We give you a quarterly report on your assets that you invested in. We send out quarterly distributions for the cash flow. I will tell you, this is a heavy value add fund. So, it's very different from, we talked earlier about ATMs. It's very different. In fact, it may be almost opposite from an ATM investment. ATM investments, very heavy cash flow, very heavy on the tax impact side, heavy on depreciation. Self-storage is a modest cash flow, somewhere in the 3 to 7% cash on cash return range. Nothing to write home about. It's also a modest depreciation play. This isn't like apartments. It's not like you can do cost sites and you can do bonus depreciation, but you don't have all those fixtures and furnishings and everything inside of a self-storage facility like you do in an apartment. So the tax impact isn't nearly as aggressive. You're really investing in this for the equity. It's really an equity play. You're making your money on the exit. So even though you get paid to hold it, you make some cash flow. It's not an aggressive cash flow play and it's not an aggressive tax play. It's an equity play and you're making your money on the exit.
You said the word fund, and that really implies that an investor is not getting into a project-specific investment, but rather a fund which holds a number of self-storage facilities in different geographies.
I'll give you an example. That property that I just told you about, the one that had the 3.1x, that was a single property that we had done before we started doing the fund model. That was a single property that we had bought and stabilized and exited a few months ago. There was also a property very unlike that one, which was also a single property deal. That was in Columbia, South Carolina. Columbia, South Carolina, that's a college town. And I think there's 7 colleges within 5 or 8 miles of there. And there's 75 colleges within 80 miles of there. But basically, you got a lot of colleges around. As you can imagine, first part of 2020 through the end of 2021, a college town, that wasn't a great place to have self-storage. Those investors, we managed to exit that project as well, but those investors, I think, made somewhere around a 17% annualized return. You look at that spread, these guys made a 61% annualized return. The guys in Columbia, South Carolina made us, I think it was a 17% annualized cash return. But now what we've done is over the last couple of years, we've kind of graduated to the fund model where you would have both of those properties inside a fund. In fact, the fund we're working on right now, Fund 3, will have 21 properties in that fund. So you get diversification across 21 properties in that fund when you invest in Fund 3. So that gives you kind of an example of where we were and then where we are today.
You syndicate and raise money from individual investors. You talked about the cash flow. You talked about the value add and the equity multiples. What should we know about timelines when one enters and wants to participate alongside you? When would they expect to get that return of principal?
So if you were to send me an email, or if you were to look at the GRE docs, and I'm sure you'll have the collateral to send out to your folks.
Yeah.
The investment summary will tell you that we projected 6 years, but our history would tell you that we're in and out within 3 to 4 years. Typically, we're into property, we do that whole value add thing we talked about, and we exit inside of 4 years. That's what our track record, that's what our history would tell you. We give ourselves 6 years because sometimes you just don't know what's going to happen within those 6 years. I mean, who knows? You could have a pandemic or some kind of something. We give ourselves a little flexibility there. We want the flexibility, and we don't want to have to sell into some kind of a market that's not favorable to a seller.
Yeah, that makes a lot of sense to think about it that way. Sure, it could take 3 or 4 years for you to do your thing after you acquire it from the mom and pop investor, adding the value, during which time the occupancy might drop until that value is added and the occupancy and that income from the tenants can be brought back up. Dave, do you have any last things to tell us, especially with respect to returns? And if one participates, how soon they could get a return?
Normally, when you invest into the fund, you're getting a return on the following quarter. So these properties that we have in the fund, they're not brand new development, and then they're also not fully stabilized to where we want them. So they're somewhere in the middle. In the early year or two, you're making, say around a 4%-ish return. That return, typically by the time you get to year 3 and year 4, you're up more closer to that 7% return. But, you're in that range. You're making that after the first quarter.
It could be more profitable than a REIT for you because you, the investor, are there capturing some of that value add component that Dave and his team put together. And they're really good about keeping in touch with their investors. For example, doing update webinars that you can attend on the project, some of which I have watched myself here in the self-storage space. If this sounds interesting to you, if you want to learn more, you can get started over at gremarketplace.com by just clicking on self-storage or going directly to gremarketplace.com/self-storage. Dave, it's been interesting to talk about a niche of real estate that often isn't discussed. Thanks so much for coming onto the show.
Thanks for having me back on your show, Keith. I enjoyed it.
Yeah, great stuff from Dave. Now, some investment types, they are not approachable for most individual investors, and some of them are, like rental single-family homes up to small or even mid-sized apartment buildings. You could buy those yourself, and perhaps you even should. There are a lot of benefits to direct real estate investing like that. But then there's some other things that you'd want to participate in, like ATMs or self-storage facilities that just aren't as conducive to the individual because you really need to scale up. So when you invest alongside an experienced syndicator like Dave, someone who I've known for close to 10 years now. I mean, I even stay at his house when I visit Pennsylvania. But see, with a syndicator like Dave, you, an individual investor, you can't just jump into anything. In fact, the SEC, the Securities and Exchange Commission, it says that you need to get access to a private placement memorandum first, a PPM. And that's a document that's very approachable. It just outlines an investment's objectives, risks, returns, and terms. And what you'll see inside a PPM are the project's financial statements and projections. You'll see management biographies and details about things like the operations, leadership, whether it's a long-term hold or a rehab, and things like that. So as far as the update on the ATMs, for the last 6 months, investor demand has exceeded the available supply, which is why he hasn't had a new ATM offering since September of 2021. And ATMs have been very lucrative for investors, and it really remains in high demand. With ATMs, don't expect any appreciation at all. but 24 to 25% cash-on-cash returns, the highest cash flow investment I know of. And it had been 100% bonus depreciation on your taxes. And now that is even heightened. That's even sweetened with leverage. A lot of GRE followers have invested in ATMs this way. If that's of interest to you, you can learn more and get started at getricheducation.com/ATM. We have done episodes devoted to that. But with this largely undiscovered real estate niche that we focused on today, self-storage facilities, the fact that you can often get in rent $1 per square foot per month on a self-storage facility, that's astounding. When you think about the fact that in a lot of markets in the U.S. today, rent income on a residential property with all of its moving parts can have rents down around $1 per square foot per month. So this is how you can start to understand why self-storage is such a profitable niche. But to get started and make it approachable for you, I mean, could you imagine trying to put together this entire self-storage business model by yourself? I mean, Dave and his team, they buy the units from mom and pop operators, then they add the size and the scale and the amenities. And that process right there, that would drop your occupancy down while they're doing the rehabbing and repositioning it. Well, most investors just could not weather that. And after the upgrade, they stabilize it by getting the occupancy up and then selling it to a REIT, a real estate investment trust. So you get to leverage all of those relationships as well. I mean, really, this is the genesis and the kinetics of how money is made. A good idea paired with an experienced operator. So with self-storage, expect a 6-year hold to be on the safe side, but history has shown that the exit is in 3 to 4 years. So that's a pretty quick turnaround if you 3x your money. 3 or 4 years ago, that was 2018 and 2019, so that goes by fast. Yeah, the return is predominantly in your equity multiple with self-storage facilities. You do get quarterly cash flow distributions along the way, but they're going to be on the lower end, about 4% at the beginning. So it's stacked toward that equity growth with the money on the exit and the type of operator with Dave's track record. If this is of interest to you, you can get started on GRE Marketplace by clicking on self-storage, or just go directly to gremarketplace.com/self-storage. You know something? It's funny, with surfacing this topic and this niche, the last couple days that I've been driving around, now I seem to notice more of these self-storage facilities where they just blended into the scenery before, and I didn't notice them. And sure enough, like how we talked about the fact that they're in accessible, highly trafficked areas, there is a nearby one at a highway exit ramp that I noticed, and there's another one about a half mile from an expressway interchange. So just watch. The rest of this week now, you're going to start noticing self-storage facilities all over your hometown. But hey, it's more than just beautiful scenery behind chain link fence on your evening commute. It can be more than that. If the space sounds interesting to you, you can get started at gremarketplace.com/self-storage and make it actionable. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.